was saying that there's cost of capital. We know that capital, it includes equity and it includes debt. Equity is the money which we are taking from our shareholders, and debt is the money which we are taking from outsiders, probably a bank loan or maybe some bond. And equity will not come for free, and similarly debt will also not come for free. You have to pay some interest to the bank, which is the lender, or you have to pay some dividend to the shareholders, which are the providers of equity. So there is cost of debt and there is cost of equity. So I'll just keep it very simple. Let's suppose that your cost of debt is 10% and your cost of equity is 12%. We discussed it last time in previous lesson that debt is usually cheaper than equity because the providers of debt, they face less risk. So what does that mean? It means that your 2 million capital is like 1 million you are taking at 12%, and 1 million you are taking at 10%. So this is 1 million at 12%, 1 million at 10%. So what do you think? What would be your average? So because it is 1 million equal, 1 million at 10%, 1 million at 12%, I can fairly say that it is 11% on average, because I give 10% on 1 million to one party, 12% on 1 million to another party. So on average, I am paying out 11% to the providers of finance. So my cost of capital here on average is, say, 11%. Now, what happens that this combination does not always remain same. For example, you have 3 million of capital, out of which you have 2 million of equity and you have 1 million, say 1 million of debt. So now this is not equal. Now the ratio between equity and debt, the ratio between equity and debt is not equal. Equity is more. So it means that you are taking 2 million equity at 12% and you are taking 1 million debt at 10%. So the 12% finance is more than 10%. Now you cannot simply take an average of 12 plus 10, 22 divided by 2, 11. How did I do it? I did it like 12 plus 10 divided by 2, which means 22 divided by 2, which means 11. This is what I did before. Now I cannot do it because the ratio is not same. Before the ratio was same, 1 million, 1 million. Now what you have, you got your debt is 1 million, equity is 2 million, and your total capital is like 3 million. Is 3 million. So what you need to do now, we need to calculate our cost of capital in a little bit different way. We'll say our cost of capital will be, how much is equity? Equity is 2 million. How much is total? It is 3 million. So 2 divided by 3 into 12% plus my debt is 1 million, total capital is 3. So I'm just taking now ratio proportion. So this is the proportion of equity, this is the proportion of debt. 2 by 3 into 12% plus 1 by 3 into 10%. So this is your formula now. Now you should also understand that when you take debt, it becomes cheaper to you. Debt is cheaper because it also gives you tax benefit. Tax benefit means that when you take debt, you record this interest cost as your expense and your tax liability becomes less. That is called tax benefit. I think that I have explained this concept before to you people, but let me explain it again. It will take me 1 minute, but I just want to show you how does it work. uh, interest expense, PBIT, profit before tax, then I pay tax, and then I say profit after tax. Let me explain you what does that mean and why I'm doing it, because it's important. I say sales are 100, cost of sale is 50, my gross profit is $50. From here my admin expenses are 10, distribution expenses are 10, and let's suppose that this is all, and you get, let's call it minus 15. So you've got profit before tax of $25, and let's suppose that your tax is 30%. So your tax is 30%, so you have to pay 30% here. So this multiplied by 0.3. So this is my tax expense and this is my profit after tax. Okay, can I make these numbers a little bit simple? Let's do it like this. So my profit after tax is 20. $6 I pay my tax expense, and my profit after tax is $14. So profit before tax 20, after tax 14. In this scenario, I create a condition. I say that you go and take a loan of $100 at 10%. So if you take a loan of $100 at 10%, you have to pay interest now. Your interest will be $10. Right now, your earnings are $14. Your profit after tax is $14. So if you are taking a loan of $100 at 10%, it means you have to pay interest of $10. So my current profit is 14. If I pay interest $10, so apparently it looks like that from 14 I pay $10 interest and I'm left with only $4. It looks like that if a further expense of $10 is introduced, your profit should decrease by $10, but it will not happen. Let's see here. I write down here minus $10. When I write down here minus $10, you see that your profit is only decreased by $7. Like it was not 14 minus 10, it is actually 14 minus 7. Because what is happening, that your tax liability is decreasing. Before you had to pay $6 tax, now you will pay only $3 tax. Because before your profit was more and you were paying more tax. But now your profit has decreased, so you are paying less tax. So you pay $10 as interest expense, but $3 you make saving on the tax. So your net cost, actually, if you ask me what is the cost of tax, so here we say that pre-tax cost of debt, and we say post-tax cost of debt. My pre-tax cost of debt is 10%, but my post-tax cost of tax is only 7% because there is only $7 difference. So in reality, what I'm losing, I'm only losing $7. My profit is only reduced by $7 because 10% I gave to the bank, but 30%, like 30% of 10%, which is 3%, 3% I made saving. So your post-tax cost of debt is only 7%. So whenever you take a debt, you get some tax advantage, and that tax benefit, usually you write it down like this. You say that 1 minus t, which means 1 minus 0.3, which means 0.7. So what it cost you is only 0.7. So this is one of the reasons why debt is cheaper, because when you give a dividend to the ordinary shareholders, this 12%, when I'm paying this 12%, this one, it will not be shown as an expense. It will not go to the income statement and it will not give you any tax benefit. But this 10%, when you are paying, this tax 10%, it is tax allowable expense. And it will go to the income statement and it will give me some tax benefit. And the cost is not 10%, actually the real cost is just 7% if the tax rate is 30%. So here when we go back to our cost of capital thing, we say that cost of capital is 2 out of 3 into 12% plus 1 out of 3 into 10%, and you say that into 1 minus t, which means you are adding the tax benefit. And I put it here, and then in 1 minus t, I write down 0.7. And then if I want to calculate my cost of capital, I just remove this part. And now I can see that what is my cost of capital? It is like 10.333%. So what is the combination? How did we got it? We got it like 2 million at 12%, and we got 1 million at 10%, and there was a tax benefit of 30% tax rate. So your net cost of capital, it comes out to be 10.333, and you give it a name WACC. WACC means, what do I mean by WACC? I'm sorry, this is somehow, my keyboard has WACC, weighted average cost of capital. So your WACC is weighted average. It's not simple average. When I was taking this number, that was simple average. Simple average means that equity was 1 million, debt was 1 million. I just said 12 and 10%, I made an average. But weighted average, you use the word weighted average because equity and debt, they have different weights within your capital. Within your capital, equity has more weight because equity is more. Debt has less weight because debt is just 1. So when you consider these weights, you are not just saying 12% plus 10% gives you 11%. You are saying that 12% with 2 million and 10% with 1 million. So weights are different, and you calculate it. And this is called WACC, weighted average cost of capital. I just gave you the summary of this chapter. This is what we are going to calculate in the next 2 lessons in this chapter. Because now the thing is that what we are going to learn now, that we know that we have to calculate weighted average cost of capital, which is called WACC. And within cost of capital, we will have cost of debt and we will have cost of equity. And what will make this topic a little bit more complex, that here I just considered one type of debt. I said we took a bank loan at 10%. In reality, you will have different types of debts. You have issued bonds, you have issued preference shares, you have taken a bank loan. So 3 different types of debts you will have with 3 different interest rates. Similarly, same rule goes for equity. You will have equity, but your equity, how would you calculate? Is it 12% or 10%? So you need to calculate yourself. In this question, I gave you that your cost of equity is, say, 12%, but not always. You have to find out how much is the cost of equity, okay?